Former Federal Reserve Governor Daniel Tarullo, he helped implement that Dodd-Frank law following the 2008 financial crisis. Before we hit just the question of what the Fed should do next week, I am curious whether you think the current banking system today is safe and how it compares to the period that you were regulating back in 2008.
Well, Andrew, I don't think there's any question that the foundations of the banking system today are much, much safer than you reported on and I observed in the fall of 2008. There's obviously questions about earnings potential in a number of banks for a number of different reasons. But in terms of capital levels and the overall soundness of the institutions, it really is just a very different ballgame than we faced 15 years ago.
And so if it is a different ballgame and you're the Federal Reserve, how do you balance and think about both whatever you think the credibility of the Federal Reserve is in regard to raising interest rates, but raising those rates relative to the possibility of putting the banking system under some more strain?
Well, I think, that the report you just got from Rick, I think, underscores the dilemma that the Fed is in for next week. On the one hand, they were leaning 50, it seemed to me, based on what had been publicly said, and that was the incoming data, the job market still very strong and the like. On the other hand, what has happened just in the last several days is, I think, going to produce a significant tightening of financial conditions. And so in some sense, what's happened is the equivalent of a federal funds rate increase. And thus, I would think that the Fed could be in a position, certainly to only go up by 25, but actually to justify a pause, not because of anxiety about the stability of the banking system, but in recognition of the fact that we have had some tightening, and that tightening is probably going to play out in the future. The data Rick just gave us is backward-looking, not forward-looking.
How much responsibility? You've seen a lot of finger pointing.
Dan?
Oh, go ahead, Steve.
Thank you. Andrew, sorry to cut you off there. Dan, I want you to wade right into what is an increasing political battle over bank finances and bank regulation. The Bank Policy Institute put out a research paper yesterday that said that Silicon Valley Bank would have passed the stress test that it was exempt from under the change to banking regulations in 2018. Does that mean that it is not an issue that those regulations were loosened, or is it an issue in your opinion?
Well, Steve, I think that the debate that's raged in the press and in the public about whether you can trace particular changes to Silicon Valley's particular situation misses a bit of the point. I mean, I understand why it's relevant, but look, the 2018 legislation was premised on the notion that banks of between $100 and $250 billion are not systemically important. Well, what did we just see this weekend? I think we saw the government essentially saying that as a group, they are systemically important. The potential for depositor runs is the classic systemic concern. And also, if you just look at the real economy, that group of banks accounts for substantial portions of commercial real estate lending, of consumer lending, of residential mortgage lending. So that the premise of the 2018 legislation, I think, was mistaken.